Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 6, Unit 1, that is, Bills of Exchange and Promissory Notes. All the concepts will be covered in the coming series of lectures. Let us begin. This is lecture number 1. Accounting for Special Transactions, Unit 1, Bills of Exchange and Promissory Notes. We'll begin with the learning objectives. After studying this unit, you will be able to understand the meaning of bills of exchange and promissory notes and also try to grasp their underlying features. We'll try to understand the accounting treatment relating to issue, acceptance and discounting, maturity and endorsement of bills in the books of drawer and in the books of drawee. Learn the techniques of accounting relating to accommodation bills. Learn the special treatment. Learn the special treatment needed in case of insolvency as well as retirement of bill. These are the concepts that we are going to learn in this unit. Overview of the unit. Bills of exchange, normal trading, accommodation. Date of expiry, due date, grace days and maturity date. Nature of bill, bill at sight, bill after date, bill on demand. Other aspects, dishonor of a bill, noting charges, renewal of a bill, insolvency, retirement of a bill and bill sent in the bank for collection. And the next is promissory notes. So bill of exchange are of two types, bill of exchange and promissory notes. Let us begin with the first element, that is bills of exchange. It is general practice then when goods are sold or services are provided, then seller extends a credit period to buyer. In some times, a seller may not be in a position to offer credit period and purchase is not in a position to pay immediately. In such a circumstances, the seller would like that the purchaser should give a definite promise, a definite promise in writing to pay the amount of goods at a certain date in which he can use to generate immediate funds. Commercial practices has developed to treat these written promises into valuable instruments of credit that when a written promise is made, the proper form of properly stamped, it is expected that the buyer discharges his debt and the seller receives payment. This is because written promises are often accepted by banks and money is advanced against them. Also, they can be endorsed easily, that is, passed on from person to person. The written promise is either in the form of bills of exchange or in the form of promissory note. So written undertaking to pay certain sum of money on a certain date is either it is known as bills of exchange or it is known as a promissory note. Let us continue. A bill of exchange has been defined as instrument in writing containing an unconditional order signed by the maker of the bill directing certain person to pay a certain amount of money only or in order to certain person or bearer of the instrument. When such an order is accepted in writing on the face of the order itself, it becomes valid bills of exchange. Suppose A orders B to pay 50,000 for 3 months after date and B accepted this order by signing his name, then it will be a bills of exchange. A bill of exchange has the following characteristics. First, it must be in writing, it must be dated, it must contain an order to pay certain sum of money, The promise to pay must be an unconditional promise. The money must be payable to a definite person or his order to the bearer. The draft must be accepted for payment by the party to whom the order is made. It should be properly stamped. Payment must be legal currency of the country. The party which makes the order is known as the drawer. It is important. The party which accepts the order is known as the acceptor, or the party to whom the amount has been paid is known as the payee. The drawer and the payee can be the same person. A bill of exchange can be passed on to another person by endorsement. Endorsement on the bill of exchange is made exactly as it is done in the case of a check. The primary liability of the bill of exchange is of the acceptor. If he does not pay, a holder can recover the amount from any of the previous endorsers or the drawee. Sometimes it may happen that the bill of exchange is drawn for foreign trade operations. Such a bill is known as foreign bill of exchange. A foreign bill of exchange is one which is drawn in one country and payable in another. It is generally drawn in a triplicate wherein each copy is sent to separate post so that at least one copy reaches the intended party. Payment will be made only on one of the copies, and when such payment is made, the other copies become useless. Section 12 of the Negotiable Instrument Act 1881 provides that all instruments which are not inland instruments are foreign instruments. A specimen of foreign bill of exchange is given over here. New Delhi. Date is given, place is given, amount is given. 90 days after date of the first bill of exchange, second and third of the same tenure and the date being unpaid, pay the order of Messrs. Vincent John and Associates, London. London. The party is from the London. The sum of rupee 11 lakh 50,000 only, value received. To Wallace Sons, Messrs. Arns, Birmingham, UK. Accepted by Wallace Sons, the drawing and stamping is done over here. The following is the examples of some foreign bills. Kindly see quickly. The following are the examples of foreign bills. A bill drawn in India on a person resident outside India and made payable outside India. A bill drawn outside India or a person resident outside India. A bill drawn outside India and made payable in India. The bill drawn outside India and made payable outside India. I believe you understood. Let us quickly do some notings. What is the bills of exchange? Written promise to pay a certain sum of money to certain person on certain date is either bill of exchange or promissory note. This written promise should be properly signed, properly stamped, properly formed. Who is a payer? Person who has to give money is known as payer. Who is a payee? Person who has to receive money is payee. I believe you must have understood till here. Let us continue. Bills of exchange. Bills of exchange is an order written by payee accepted by drawee in case drawee fails to pay. It shall be paid by drawer. Bills of exchange, three parties. Drawer, drawee, payee. Drawer and drawee both can be the payer. Drawer is the one who gives guarantee. Drawee is the payer. Drawer could also be the payer because he gives the guarantee on behalf of the drawee. Payee writes bills of exchange. And drawee accepts bills of exchange. I believe it is clear till here. I believe it is clear. Let us continue. Write a sample, date, whatever. I have to pay Mr. Y rupee 5 lakh on this date. Drawee will sign over here and drawer will sign over here. Let us continue. This was about bills of exchange. Now, promissory note. Promissory note is a promise written by payer, that is maker of the bill. Here the liability is absolute. I promise to pay Mr. Y rupee 5 lakh on this date. Date of making of the bill. Y is payee over here. The maker of the will, that is the payer, will sign. Maker of the bill will sign. Promissory notes, two parties are there. Two parties, maker and payee. Maker writes the promissory note. Also known as promisor. Payee is promisee. Bill of exchange and promissory note both are negotiable instrument. No acceptance is required in case of promissory note because the payer and the maker is same. Next, foreign bill. Right, place where bill is drawn. Another column, person on whom bill is drawn. Place where bill is payable. Bill. Place where bill is drawn. Supposingly in India the bill is drawn. Person on whom bill is drawn, resident in India, that person is resident in India. Place where bill is payable is also India. This bill is a domestic bill. This bill is domestic bill and not a foreign bill. Next, place where bill is drawn, supposingly outside India. Person on whom bill is drawn, This person is resident in India. Place where bill is payable, supposingly this is also India, but still bill is termed as foreign bill. Why? Because the place where bill is drawn in outside India. Out of these three elements, 1, 2 and 3, if anything is outside India, the bill will be termed as foreign bill. Take one more example. Place where bill is drawn, suppose this is India. Person on whom billing is drawn, suppose this is resident outside India. Resident outside India. Now this is outside India, it would be termed as foreign bill. Place where bill is payable is India, still the bill will be termed as foreign bill. I believe you understood. Take one more example. Place where bill is drawn, supposingly this is India. Person on whom bill is drawn, resident in India. Resident in India. Place where it is payable, supposingly this is outside India. This is outside India. The bill will be termed as foreign bill. The bill will be termed as foreign bill. I believe you understood. I believe you understood till here. Let us continue. Bill of exchange, promissory note. For payee, the bill of exchange is an asset, but for payer, it is a liability. For payee, it is an asset. For payer, it is a liability. It is asset for payee. Which asset? Bills receivable. Bills receivable. For payer, it is a liability. It is a liability for payer. Bills payable. Who writes bill of exchange? Drawee writes bill of exchange. And who writes a promissory note? The maker writes a promissory note. Journal entry. Journal entry. A draws a bill on B for rupee 5,000. If it is written bill in the question, this means bills of exchange. Bills of exchange. Don't assume this as a promissory note. A draws. Who draws? Payee draws a bill. This is bills receivable for the payee. Over here, B is the payer. A draws a bill on B. Now B will sign and accept. Who is the payer? B is the payer. So this bill is a bills payable. For the payer it is bills payable. For the receiver it is, for the payee it is bills receivable. What entry would be passed in the books of A or B? In the books of A, bills receivable account debited to B, and in the books of B, A account debit to bills payable account. I believe you understood. Why this bills receivable over here? Because how these entry has generated, just see over here, there must be a sale, so B to sales, and then this entry is passed, bills receivable to B. Over here there must be a purchase, so the entry would be purchases to A, and then A to bills payable. I believe you understood. Let us continue. Promissory note. A promissory note is an instrument in writing, not being a bank note or a currency note, containing an unconditional undertaking signed by the maker to pay a certain amount of money only to or to the order of a certain person. Under Section 31(2), the Reserve Bank of India Act, a promissory note cannot be made payable to the bearer. So there must be certain name on the promissory note. Let's see the characteristics of a promissory note. It must be in writing. It must contain a clear promise to pay. Mere acknowledgement of a debt is not promissory note. Third, the promise to pay should be unconditional. I promise to pay 50,000 as soon as I can is not a unconditional promise. So this won't be a promissory note. Next, the promisor or maker must sign the promissory note. The maker must be a certain person. The payee, the person on whom the payment is promised, must be a certain person. The sum payable must be certain. Sum payable must be certain. I promise to pay 50,000 plus all fine is not certain. Payment must be legal currency, in legal currency. It should not be payable to the bearer. It should be properly stamped. It does not require any acceptance. Does not require any acceptance. But bills of exchange require acceptance. Promissory note don't require acceptance. Specimen of a promissory note is given over here. 3 months after date, I promise to pay Priya on her order a sum of 10 lakhs for value received. Stamping is done. Payee, maker. Priya is payee. Rohan is the maker. Stamping is done over here. Date, address, everything is written. Difference between bills of exchange and promissory note. Bills of exchange. A bill of exchange contain an unconditional order to pay. Promissory note. A promissory note contains only a promise to pay a certain sum of money. There are generally three parties, drawer, drawee and payee in case of bills of exchange. In case of promissory note, there are two parties, that is maker and payee. A bill is paid by the acceptor. A promissory note is paid by the maker. A bill is drawn by creditor. A promissory note is made by the debtor. a maker or payer or debtor is the same person. The debtor or payee may be the same person in case of a bills of exchange. The drawer and payee may be the same person in case of a bills of exchange. In promissory note, the maker and payee cannot be the same person. In case of bills of exchange, the liability of drawer is secondary and conditional. If the payer will not pay, the drawer needs to pay. In case of, because he has given the guarantee. In case of a promissory note, the liability of maker is primary and absolute. There is no guarantee required. In case of bills of exchange can be accepted unconditionally. In a bill of exchange, notice of dishonor must be given. A promissory note cannot be made conditionally. Notice of the dishonor is not required in case of a promissory note. In case of dishonor, the bill of exchange must be noted and protested. Noting and protest is not required in case of dishonor of a promissory note. Next point. Record of bill of exchange and promissory notes. A party which receives a promissory note or receives an accepted bill of exchange will treat it as new asset under the name of bills receivable. A party which issues a promissory note or accepts the bill of exchange will treat the new liability under the heading bills payable. We shall first deal with the entries in the books of the party which receives the promissory notes or bills. Then we'll talk of, when we talk of bills, we'll include the promissory notes also. On receipt of bill, the payee makes the following entry in the books of accounts. Bills receivable account debit to drawer or maker of the note. A accepts a bill of exchange drawn on him by B. In the books of B, the entry will be bills receivable account to A. A sends to B the acceptance of D. In this case also, the entry in the books of B will be bills receivable account to A. A person who receives the bill has three options. These are: he can hold the bill till maturity. Naturally, in this case, no further entry is passed until the date of maturity arrives. Next, the bill can be endorsed in favor of another party, say Z. In this case, the entry will be to the debit of party which now receives the bill, and to credit of the bills receivable account. So Z account debited to bills receivable account. This is a case of endorsement. Third, a bill of exchange can be discounted with the bank. The bank will deduct a small sum of money as discounting charges and pay the rest of the money. So bank account debited, discount account debited to bills receivable account. I believe it is clear. On the date of maturity, there will be two possibilities again. The first is that the bill will be paid. This is to say, met, or the bill will be honored. The entries for this will depend upon what was done to the bill during the period of maturity. If the bill was kept, the cash will be received by the party with original received the bill. In this case, therefore, the entry will be cash account debited to bills receivable account, cancellation of the bill. But if he has already endorsed the bill in favor of some creditor, or if the bill has been discounted with the bank, he will not get the amount. It will be the creditor or the bank which receives the money. Therefore, in these two cases, no entry will be made in the books of party which originally received the bill. Next option. The second possibility is that the bill will be dishonored, the payment is not made. This is to say the bill will not be paid. If the bill is dishonored, the bill becomes useless and the party from whom the bill was received will be liable to pay the amount again and also the expenses incurred by the party. Therefore, the following entries will be made. First, if the bill was kept till maturity, then drawer or maker to bills receivable account. If the bill was endorsed in favor of creditor, then drawee or maker of the note to bills payable account. And if the bill is discounted in the bank, then drawee maker to bank account. Thus, it will be seen that in case of a dishonor, the party which gave the bill has to be debited because it has become liable for the amount, to pay the amount. The credit entry in this bills receivable account, if it was retained, or the creditor of the bank, if it was endorsed, discounted in their favor. Term of a bill. The term of a bill of exchange may be of any duration. Usually, the term does not exceed 90 days from the date of the bill. When the bill is drawn after sight, the term of the bill begins to run from the date of citing, that is, when the bill is accepted. The date of acceptance will be taken into account. When the bill is drawn after date, the term of the bill begins to run from the date of drawing of the bill. I believe you understood. Term of a bill. Next, expiry or due date of a bill. The date on which the term of a bill is terminating is known as the expiry or date of a bill. Grace days. There are 3 days of grace. So every instrument payable otherwise than on demand is entitled to 3 days of grace. 3 grace days. Next, the date of maturity of bill. The date which comes after adding 3 days to the expiry date of a bill is called the date of maturity. The maturity of a promissory note or bill of exchange is the date at which it falls due. Every promissory note or bill of exchange gets matured on the 3rd day after the day on which it is expressed to be payable, except when it is expressed to be payable on demand, at sight, or on presentment. So in these 3 cases, the grace days will not be available. Grace days of 3 days. Next is bill at sight. Bill at sight means the instrument in which no time of payment is mentioned. A check is always payable on demand. A promissory note or bill of exchange is payable on demand. A. When no time or payment is specified. B. When it is expressed to be payable on demand or at sight or on presentment. Note: at sight and presentment means on demand. An instrument payable on demand may be presented for payment at any time. Days of grace is not added to calculate the maturity in such type of bill. Next is bill after date. Bill after date means that the instrument in which the time for payment is mentioned. A promissory note or bill of exchange is a time instrument when it is expressed to the payable after a specified period, on a specified day, after sight, or on a happening of certain event which is certain to happen. Note: the expression after sight over here means in a promissory note after presentment for sight. in a bill of exchange after acceptance or noting for non-acceptance or protest for non-acceptance. Second, a check cannot be a time instrument because the check is always payable on demand, though a check can be post-dated or which can be presented on or such date. A check has validity of 90 days from the date. After that, it becomes void. Normally termed as stale check, or a bank will not honor such kind of checks. How to calculate the due date of a bill? When bill is made payable on specific date, that specific date will be the due date. When the bill is made payable at a stated number of months after date, that date on which the term of bill shall expire will be the due date. Note, the term shall expire on that day of the month which corresponds to the day on which the bill is dated. If the month in which the period terminates has no corresponding day, the period shall be deemed to be expire on the last day of the month. For example, a bill signed on 31st January payable after 3 months. So 3 months will be 31st April, but 31st April is not a date, so 30th April will be the due date. Next, when the bill is made payable at a stated number of days after date, that date which comes after adding stated number of days to the date of bill shall be the due date. When the due date is a public holiday, the preceding business day, a day before, preceding business day shall be the due date. When the due date is in the case of emergency, when the due date is an emergency or a due unforeseen holiday, it's a curfew. In that case, the next following day will be the date. That is a business day. The next following day will be the date. I believe you understood. Note, the term of a bill after sight commences from the date of acceptance of a bill, whereas the term of a bill after date will commences from the date of drawing of a bill. Next is noting charges. It is necessary that the fact of dishonor and the causes of dishonor should be established. If the acceptor can prove that the bill was properly presented to him for payment, he may escape liability. Therefore, there is dishonor or fear of dishonor. The bill will be given to the public official known as notary public. These officials present the bill for payment, and if the money is received, they will hand over the money to the original party. But if the bill is dishonored, they will note the fact of dishonor with the reasons and give the bill back to the client. For this service, they charge a very small fee. This fee is known as noting charges. The amount of noting charges is recoverable from the party which is responsible for the dishonor. Suppose X received from Y a bill of 1000. On maturity, the bill is dishonored and rupee 10 is paid as noting charges. The entry in this case will be Y account debit 1010 to bills receivable 1000, but Y also needs to be debited for the 10 rupees, that is the noting charges, to bank account 10 rupees. Suppose, so Y account debit 1010 to bills payable amount is 1000 and bank account is 10. Suppose X had endorsed this bill in favor of Z. Endorsement is done. In this case, the entry for dishonor would have been Y account debit 1010 to Z 1010. This is because Z will claim 1010 from 1010 rupees from X, and X has the right to recover the 10 rupees, that is 1010 rupees, from Mr. Y. Similarly, if the bill has been discounted with the bank, the entry would be Y account debit 1010 to bank account 1010. Next is renewal of bill. Sometimes the acceptor is unable to pay the amount and himself moves that they should be given extension of time, and the consideration agrees to bear interest for the extended time period calculated from the date of renewal till the date of expected settlement. In such a case, of new bill will be drawn and the old bill will be cancelled. If this happens, entry should be passed for cancellation of the old bill. This is done exactly as already explained for dishonor. When the new bill is received, entries for receipt of the bill will be repeated. The amount of new bill may be represent of the following. Number one, where the drawee pays nothing, the total of the amount of original bill as well as the interest for the extended time period. Where the drawee pays the interest amount at the time of renewal, the amount of original bill, because he has already paid the interest amount, so the new will be of the original bill only. The new amount or the new bill be with the original amount only. And third, where the drawee makes the part payment of the original bill or interest amount or both. That part of the total of amount of original bill as well as the interest for the extended time period of an unpaid amount. Next, retirement of a bill of exchange and rebate. We have seen that the renewal of a bill of exchange is made when the person does not have sufficient fund to pay for bill of exchange or on the due date and he requires a further period of credit. Many a time instances do arise when the acceptor has spare funds much before the maturity date of bills of exchange accepted by him. In such a case, he approaches the payee of the bill of exchange and asks whether the payee is prepared to accept cash before the maturity date. In such a case, the acceptor gets a certain rebate or interest or discount for early payment, premature payment. The rebate becomes the income of the acceptor and expense for the payee because he had accepted the payment early. It is consideration for the premature early payment. Next is insolvency. Many a times it happens that somebody files a request to the court for insolvency. Insolvency of a person means that he is unable to pay his liabilities. This means that the bills accepted by him will be dishonored now. Therefore, when it is known to that person has become insolvent, entry of the dishonor of his acceptant must be passed. Later on, something may be received from his estate when and if any amount is received, cash account will be debited and the personal account of the debtor will be credited. The remaining amount will be irrecoverable and therefore should be written off as bad debt. The students also be careful to calculate the amount actually received from the insolvent estate and the amount to be written off only after preparing his account. In the books of drawee of bill, the amount not ultimately paid by him due to insolvency should be credited to deficiency amount. Next concept is accommodation bills. In case of accommodation bill, there is neither any sale or nor there any purchase. So I'll quote an example. There are two friends. They are in urgent need of funds. A draws a bill on B. Now B accepts it and give it back to A. Now A goes to the bank and discount it. They share the funds 50-50 or in the prescribed ratio, and at the date of maturity, they pay it back to the bank. This is an example of accommodation bill. Let us see. Bills of exchange are usually drawn to facilitate trade transmission. That is, bills are meant to finance actual purchase and actual sales, but the mechanism of the bill can be utilized to raise finance also. Suppose boss needs finance for 3 months. In that case, he may persuade his friend Kapoor to accept his draft. The bill of exchange may then be taken by the boss to his bank and then discounted over there. Thus, boss will be able to make use of the funds for these 3 months. When the 3 months period is over, expires, boss will send the requisite amount to Kapoor and Kapoor will make the payment of the bill. Boss is able to raise money for his use. If boss and Kapoor need money, the same device can be used. Either boss accepts the bill or Kapoor accepts the bill. In either case, the bill will be discounted with the bank and proceeds could be divided between the two parties according to the mutual agreement. The discounting charges must be borne by the two parties in the same ratio as the proceeds are divided. On the due date, the acceptor will receive from the other party the share and the bill will then be met. The bills are used for such purposes is known as accommodation bill. Real purchase and sales do not happen in case of accommodation bills. However, it may so happen that the drawer is not able to remit the proceeds to drawee on the due date. In such a case, the drawee may draw a bill on the drawer and get it discounted with the bank to honor the first bill. If the new drawee of the first bill, also remits some proceeds of the new bill to new drawer of the first bill, then the proportion of discount to be borne by the new drawee will be based upon the proceeds remitted as well as benefit obtained by him on the first bill, that is, by not paying the amount due to the original drawee on the due date. I believe you understood. Entries are passed in the books of two parties exactly in the way already pointed out for ordinary bills. The only additional entry to be passed is for sending the remittances of one party to the other party and debiting the other party the shared amount of the discount. Next, bills of collection. When the person receives a bill of exchange, he may decide to retain the bill till the maturity date, but in order to ensure safety, he may send it back with instructions that the bill should be retained till maturity and should be realized on that date. This does not mean that the discounting, because the bill will not credit the client until the amount is actually realized. If the bill is sent to the bank with such instruction, it is known as bill sent to bank for collection. It is better to make a record of this also in the books, passing the following entries. Bill sent for collection account debit to bills receivable account. When the amount is realized, the entry will be bank account to bill sent for collection account. When the amount is not honored on the entry will be maturity date, the entry will be party from whom the bill was received will become again the debtor to bills for collection account. Next, bills receivable and bills payable books. Bills receivable and bills payable books are journals, day books, record in a chronological order the details of bills and bills payable. When large number of transactions take place in the organization, it is convenient to maintain these books wherein any transaction take place, the same is entered in the day book in the first instance. Posting to individual debtor and creditor accounts are made from the day book. Also, totals of bills received and accepted are posted periodically to bills receivable account and bills payable account respectively. Bills receivable account and payable account is very useful for following up the status of the outstanding bill when there are large number of bills and these bills falls due on different dates. Some of these bills may not be honored on maturity date and varied reason it is possible from these day books to trace the details of the outstanding bills and to identify the reasons for not honoring the bill. Given below are forms of day books of both bills receivable and bills payable. Bills receivable book and bills payable book. Here are the examples. Write a question over here. X draws a bill on Y X endorsed the bill to Z, who is the payee of bill. First, the payee will be X, Y will be the Y will be the drawee. Now, because this endorsement is done, payee will become Z. Mr. Z is the payee. I believe you understood. Next question. Question 2. On 1st January 2014, X draws a bill on Y for 50,000 for 3 months. X got the bill discounted on 4th January 2014 at 12%. This is the rate. What is the amount of discount? What is the amount of discount? The bill amount over here is 50,000. The rate is 12%. The month is 3 months. Do it in your calculators. 1500. It is 1500. Next question. Question 3. Mr. A draws a bill on Mr. Y for rupee 30,000 on 1st January 2014 for 3 months. On 4th February 2014, X got the bill discounted at 12% rate. What is the amount of discount? $30,000, 12%, 2 months, 600. The bill is drawn for 3 months over here. The 1 month is already covered because this is 1st of January, this is 4th of February, and 3 months of grace is already settled over here. So 1st of January to 4th of February, inclusive of 3 days of grace, it is 2 months. I believe you understood. Next. Calculate maturity date. Calculate maturity date. Two months bill drawn on 2nd July. So 2nd July plus 2 months plus 3 grace days. 3 days of grace. So this is 2nd September plus 3 grace days. 5th September. Next, three months bill drawn on 1st October. 1st October plus 3 months plus 3 grace days. It is 1st January plus 3 grace days, 4th January. I believe it is clear. Next, one month bill drawn on 30th November. 30th November plus 1 month plus 3 grace days. So 30th December plus 3 grace days, 2nd January. 2nd January. I believe you understood till here. Next example. 1 month bill drawn on 31st October. So 31st October plus 1 month plus 3 grace days equals 30th November. 31st October plus 1 month is 30th November. Because 1 month is 31 November, but 31st November there is no date such called 31st November. So 30th November plus 3 grace days. It is 3rd December. I believe you understood. Next question. 1 month bill drawn on 28th Feb. So 1 month 28th Feb. 28th Feb plus 1 month plus 3 grace days. 28th Feb to 28th of March. Oh, it is the last day of the month, 28th Feb. So it is 30th, 31st March and 3 days of grace, 3rd April. 3rd April. One more example. 2 month bill drawn on students kindly do the correction over here. 1 month bill drawn on 28th of Feb. So it is 28th Feb plus 1 month plus 3 grace days. It is 28th March plus 3 grace days, 31st March. Next, 2 month bill drawn on 31st of January. So 31st January, 2 month, February and March. 31st March plus 3 days is 3rd April. 2 month from 31st January, so February and March, 2 months. 31st March plus 3 days is 3rd of April. I believe you understood. Write a note over here write a note quickly. If there is if there is no such date, if there is no such date in the corresponding month, the last date of such month is taken. The last date of such month is taken. I believe you understood. Next question, question 4. Next question. A bill of rupee 12,000 were discounted with the banker for rupee 11,880. At maturity of the bill, returned dishonored. Noting charges rupee 20. How much amount will bank deduct from A's account with the bank? So bank will collect this 12,000 plus noting charges, that is 20. Answer: 12,000 plus 20, 12,020. I believe you understood. Let us move ahead. Write an example. Two-month bill drawn on 1st of April 2014, accepted on 5th of April 2014, calculate maturity date if the bill is after sight. After sight, so it is to be calculated from the date of acceptance and not on the date of drawn. So 5 April 2014, it's a 2-month bill plus 3 grace days, eight 6 2014. I believe you understood this example. Next example. In the above example, calculate maturity date if the bill is after date and not after sight. So after date is calculated on the date of bill drawn, 1st April 2014. 1st April 2014 plus 2-month plus 3 grace days. So it is 4/6/2014. I believe you understood. Write a note over here. If the question is silent, whether the bill drawn is after sight or after date, it shall be assumed that it is after date. I believe you understood. Let us continue. Write an example. Example: 3 months bill drawn. 3 months bill drawn on 30th September. Calculate maturity date. 30th September, 3 months. October, November, December. 30th December plus 3 days is 2nd of January. 30th September, 30th October, 30th November, 30th December plus 3 days, 31st December, 1st January, 2nd January. I believe you understood. Next example. Two-month bill drawn on 18th July, accepted on 25th July. Bill drawn after date, payable on site. Payable on site, this means no grace days is allowed. No grace days is allowed. We only need to calculate 2 months. So 18 July, 18th August, 18th September. It's 18 September. No 3 days of grace is allowed over here. So 18 September is the maturity date. I believe you understood. Let us continue. Next question, question 5. X draws a bill on Y for rupee 30,000 on 1st April 2015. X accepts the same on 4th April 2015 for a period of 3 months after date. What is maturity date? What is maturity date? First April 2015 plus 3 months plus 3 grace days. Calculate it quickly. 1st April 2015 plus 3 months. 1st January 2015. So it is 1st April 2015 plus 3 days. 4th April 2015. It's 4th April 2015. I believe you understood. Let us continue. Next question, question 6. X draws draws a bill on Y for rupee 20,000 on 1st January 2005 for 3 months after sight. Date of acceptance of bill is 6 January 2005. What is maturity date? Solve it quickly. So it is 6th January 2005 plus 3 months plus 3 grace days. So it is 9th April 2005. 9th April 2005. Next question. Example. Two-month bill payable on site drawn on 15th June. It is on site, that means no grace days. No grace days is allowed. So from 15th June 2 months is 15th August, but 15th August is a holiday. So one day before, it is 14th August. The maturity date is 14th August. Next example. 2-month bill payable. 2-month bill payable on site drawn on 14th June. So 14th June, July and August. 14th August. 14 June plus 2 months is 14th August. But 14th August is an emergency holiday. 14th August is an emergency holiday. So 16th August. The next business day. 15th August is also a holiday, national holiday. 15th August. So it is a 16th August. 16th August. I believe you understood. Next question. Question 7. On 1st January 2005, X draws a bill on Y for 15,000 for 3 months. At maturity, Y request X to accept rupee 5,000 in cash. That means Y had paid 5,000 out of 15,000, and for balance to draw a fresh bill for 2 months together with 12% of interest. What is the amount of interest over here? What is the amount of interest? amount of interest equals to, see, out of 15,500, 5,000 is paid, so remaining is 10,000. Interest is 12% for 2 months. It is 200. It is 200. Next question, question 8. On 1st January 2005, X draws a bill on Y for rupee 30,000. At maturity, Y requests X to draw a fresh bill for 2 months together with 12% interest. Noting charges rupee 100 over here. The amount of interest will be dash 30,000 plus noting charges 100. This is to be added. 30,100, 12% for 2 months. Do it on your calculators fast. 602. Next question, question 9. Question 9. For mutual accommodation of A and B, B accepted a bill drawn on him by A for 2 months for rupees 6,000. The said bill is discounted at 12% per annum and remitted 1/3 of the proceeds to B. The amount remitted by A to B will be dash. It is 6,000 discount multiplied by 12% for 2 months, 120. Amount received from bank, 6,000 minus 120. That means 5,880. Amount remitted to B is 1/3 of 5,880. That is 1960. 1960. I believe it is clear. Next question. Question 10. L draws on accommodation bill on S, the proceeds are to be borne between S and L in the ratio of 3:1. The amount of bill is rupees 6,000. Discounting charges rupee 120. What amount of discount shall be borne by S? How will solve it? The discounting charges is 120. He will born the 3 by 4. 3 by 4. That is rupee 90. Rupee 90. Next question. A draws a bill on B for rupee 4,500 for mutual accommodation in ratio of 2:1. A got it discounted at rupee 4,230. This is the discount amount, the difference, and remitted one third of the proceeds to B. At the time of maturity, how much amount A should remit to B so that B can pay off to bank. I believe you understood. So over here, the bill is of 4,500, two-third to be remitted. So it is 3,000. Next question, question 12. A bill of rupee 10,000 for 3 months discounted after 1 month. Compute discount at the rate 12%. Discount amount will be 10,000 multiplied by 12%, 2 months, 200. Next question. A bill of rupee 5,000 for 3 months, retired 1 month before. Retired 1 month before the due date. Before the due date. Compute rebate. Compute rebate if rate is 12%, if the rate is 12%, so the bill is of 5,000, the rate of rebate is 12%, so 12%, and this is 1 by 12, 1 month, 1 by 12, 50. 50. Next question. Question 14. 3-month bill of rupee 10,000 renewed for 2 months on the condition that 30% is paid immediately. 30% is paid immediately. Compute interest. Compute interest if rate is 12%. So 10,000 and 30% is paid immediately. So left is 7,000. 12% for 2 months, 140. 3-month bill of 10,000 renewed for 2 months on the condition that 30% is paid. So out of 10,000, 3,000 is paid. Rest 2 months is there. So 7,000, 12%, 2 months, it's 140. Next question. Question 15. Three-month bill of rupee 5,000 was dishonored. Noting charges were rupee 100 and bill is being renewed for 4 months. Compute interest if rate is 12%. 5,000 plus 100, 5,100, 12%, renewed for 4 months, 204, rupee 200. Next question. On 1st January 2016, we draws a bill of exchange for rupee 10,000 due for payment after 3 months on E. E accepts this bills of exchange. On 4th March 2016, E retires the bill of exchange at a discount of 12% per annum. Compute rebate available to E. Answer. First calculate the maturity date. 4th April 2016. First January plus 3 months plus 3 days. Now rebate for 1 month, 10,000, 12% for 1 month, 1 by 12, 100. 100. I believe you understood. We are stopping here. We are stopping here. Thank you. Thank you.